Now, let's listen to what President Trump said about trade negotiations with China. Watch.
145% is very high, and it won't be that high. It's not going to be that high. It got up to there. We were talking about fentanyl, where, various elements built it up to 145. No, it won't be anywhere near that high.
And what level in there come down if you have?
It'll come down substantially, but it won't be zero. We're going to be very good to China, have a great relationship with President Xi, but they would make billions and billions and billions of dollars a year, and they would build their military out of the United States.
EJ Antoni joins me now. He's an economist, by the way, right-hand side of the screen. Trump talks about de-escalation with China. What does de-escalation look like, EJ?
Stuart, I think it looks like freer and fairer trade, and that includes not just reduction in tariff rates, but also reductions in non-tariff barriers. That includes things like quotas, currency manipulation, but it also means cracking down on China's IP theft, on their abuse of trade agreements, like using backdoors in the USMCA, abusing country of origin provisions so that they can dump products in a place like Canada and then relabel it, repackage it, and reship it into the United States. So as all of those things get fixed, in other words, as the CCP starts to behave, you're going to see these tariff rates come down, and you're going to see more free trade, not less.
Do we have the leverage to make that happen? I mean, is China isolated? Are they vulnerable? What leverage do we have? Because you're talking about some significant change here.
Oh, absolutely, Stuart. I mean, this really is a restructuring of the global order when it comes to international trade. So I think you're absolutely right. It's all about leverage. Do we have the leverage? I think we're getting there. And that we get that leverage, essentially, Stuart, by isolating China's main trading partners, by peeling nations out of their sphere of influence through beneficial trade deals and getting them into our sphere of influence. That is why trade deals with Japan, with India, with Australia, those nations are so key in these early stages. And that's why I'm so happy, quite frankly, to hear news on Japan and India coming to the table, and the fact that although we don't have a deal yet, the details are being hammered out. Again, that's great news. That's restoring certainty to this market, something that is desperately needed after weeks of so much uncertainty and so much turmoil.
There's a lot of talk about inflation coming because of tariffs. But you think, I believe, that inflation from tariffs is just a one-off price increase. Up they go, and that's it, right?
Well, very nearly, Stuart. The only caveat I would throw in there is the fact that although you can get a one-time increase, don't be surprised if that is followed by a one-time decrease as the trade war de-escalates, as we reshore manufacturing, and as the manufacturing base leaves China and goes to its neighbors, again, countries like India or Japan. So just because you do get that one-time price increase, I would not think of it the same way we think of the price increases that we saw beginning in 2021, where, yes, prices went up and now they're never coming back down. Instead, again, don't be surprised if that one-time price increase is followed by a one-time decrease and we reset back to baseline.
At the moment, the economy and the markets really completely focused on tariffs and the Fed. Should we now be focusing more on tax cuts?
Oh, absolutely. As those things start to come into focus, Stuart, whether it's the tax cuts or whether it's deregulation really ramping up into high gear, all of those things are going to start to have an outsized impact on the market. Let's not forget the total size of this tax cut package is probably going to end up being about 10x all of the costs of tariffs that we can expect to fall on the American consumer. In other words, it pales in comparison. So again, as these other things get across the finish line that are much bigger than tariffs, I think that's where the market is really going to start to focus. The problem is we're just not there yet, right? We don't have a tax deal done. We don't have a lot of the deregulatory agenda across the finish line, but definitely look to those items as they get closer.
Will Trump save the market every time it needs help?
I don't think so, Stuart, for a couple of reasons. One is the fact that markets are going to move up and down on a very short-term basis, and so much of what this president is focused on is the long-term agenda. And second is there's only so much the president can do here, right? Markets are moving for a whole lot of different reasons, some of which are in the president's control, but some of which are outside the president's control. Whether it's the Fed or Congress, the president is limited in what he can do in his executive authority. And I think Trump understands that.
However, the big sell-off in the market has really upset a lot of people's 401ks, which could bring political unpopularity to President Trump. So he turns around and helps the market out. And that's not too far short of the truth, is it?
Well, Stuart, again, the president's limited in what he can do. Now, I think he can help give a sense of calm to the markets through rhetoric. And I think a lot of his policies can help bring certainty to the market. The 90-day pause, for example, I think was very, very wise. They already had so many nations coming to the table willing to negotiate. They caused enough turmoil overseas. It was time to calm the turmoil here at home. So, again, those kinds of policy tweaks can be very, very helpful in restoring certainty back to the marketplace, which is really, really helpful, as well as the fight with Powell, for example. That has helped restore some certainty. It's not that keeping Powell in place is good for markets because Powell's a good Fed chief. He's not. He's terrible. He gave us the highest inflation in 40 years, the fastest rise in interest rates in 40 years. He wrecked the bond market. We had the worst 3.5-year run in terms of real bond returns in at least a century. Powell has done an abysmal job, but it is another element of uncertainty that the market doesn't need right now to have all this talk about firing or replacing Powell. So just keeping him here for now, getting rid of that whole argument was good for the markets because it helped with certainty.
All right, EJ, we hear you. EJ Antoni, thanks very much for joining us. Appreciate it always.